Hey YouTube family, welcome to another video of the Kevin Strong Show. And in this video, we're going to talk about home price versus interest rate. What do you do? There's a big debate out there. Do you overpay for a house because you got a really good interest rate, or do you patiently wait on the sidelines, maybe at the expense of a higher interest rates, but you're hoping that the home price will come down? So we're going to talk about that in this video. I'm very excited about this. Once again, if you're enjoying this type of content, please do me the honor of smashing that like button. If you haven't subscribed to my channel, please click that subscribe button. And if you're finding value in this content, not only leave me a comment, but share the video. So really excited about this. So let me set this up. The situation is this: there's two households. One's going to buy high, one's going to buy low. Everything's the same. The house, the amenities, the square footage, the neighborhood, the household debt, the household income, the household liabilities, the household assets. Just to do a case study on what do you do. So please stick until the end of this video to find out what the numbers say. And then obviously once I get to that conclusion, I'm going to give you my little editorial comment about which one I would do. Would it be the interest rate, or would it be the home price? So without further ado, let's go ahead and jump into this. So let me set this up. Like I said earlier, this is a mortgage calculator. So my scenario deals with this. We've got two families. They're going to purchase the exact same home. One's going to get it overpriced, and the other one's going to wait because they want a cheaper price, but they're going to pay a significantly higher. They're going to have a much higher interest rate. So here's the scenario. Couple number one, they jump in within the last 12 months. Let's say they overpay or whatever, but the house was $400,000. They put 20% down on a $400,000 house because they did not want PMI, private mortgage insurance. But even though they may have overpaid for the house, they got a really good interest rate. And let me go ahead and pop that in here for a second. And we're going to say that interest rate was 3.25%. on a 30-year fix after putting 20% down. So they're basically mortgaging $320,000. Okay. So the principal and interest payment, we're not going to talk about property taxes because that could change over time. Homeowners insurance. We're strictly evaluating the payment, principal and interest only. So that payment obviously is $1,392. So we're going to round that off to roughly $1,393. The other camp says, hold up a second. I'm going to, that bald-headed guy out of south of Seattle, he's pretty good. So I think I'm going to wait. I'm going to take Kevin's advice. So I'm going to wait, and I'm going to be rewarded by waiting. Home prices is going to come down 20% in this particular example. So now that same house is $320,000. It's 20% cheaper than when the other couple bought it at $400,000. So as a result of that, I don't have to come up with $80,000 down. I only have to come up with $64,000. Okay, keep in mind, I set this up where everything's the same. So now there's a $16,000 savings from the down payment portion of this case study. But since I waited, that 30-year fixed rate really went up, and we're going to shoot this up to 7.25, something, realistic. And as a result of that, that principal and interest payment is $1,746. The other payment was $1,393. So even though the first household paid $80,000 more for the house, their payment is $353 per month cheaper. So let me switch my screen here and go back to this. Okay, so here's the setup. The family who paid $400,000 has a cheaper payment of $353 a month. That family is saving $4,200 a year in mortgage payment. The other family paid $80,000 less, but their payment is much higher. It's $1,746. So here's where it gets interesting in a vacuum. That family that paid $400,000 for that house, let's say they're saving $4,200 a year in payment compared to the other family. So they want their money to go to work for them. So they're going to stick that money into an S&P index fund that's giving them an annual rate of return of 8%. okay? 8%. So over a 10-year period, if you are putting $4,200 into this fund and you're averaging an 8% return on your money, okay, at the end of 10 years, you roughly have $70,000, which sounds pretty good. Hold up, wait a minute. Remember I told you that the couple that waited and got that 20% haircut on the home price and they paid $320,000? How much was their down payment that they saved? It was $16,000. So now they're going to take that down payment money that they saved as a result of not paying a higher price, and they're going to put that $16,000 into the same fund, the S&P index fund, as the first family. So over a 10-year period, that $16,000 is $30,000. So the couple who paid a higher price for the home got $70,000 for putting that lower payment money, that extra money that they're saving on their mortgage payment, putting that money to work in the stock market. They got $70,000 as a reward over a 10-year period. The other family got $30,000 because they put their down payment into the stock market and let that money work for them. So what's the difference? The $70,000, okay, you got to subtract the $30,000 that other couple got from investing their down payment money. So that leaves the person who paid the higher home price only a net savings of $40,000 after 10 years. But remember this case study. We started off with what? That first family paying $80,000 more for the home. They only got a net savings of $40,000. Where is the other $40,000 coming from? They're still in the red, not to mention inflation. But I didn't bring inflation into the equation because inflation would affect both households equally because they have the same amount of debt, assets, and liabilities. But you see where I'm going? The 70,000 subtracted the 30,000, that only puts that family up $40,000, but they paid $80,000 more for the house. Not to mention, in the event that there's a life crisis, that first family is probably upside down in that house. Most real estate transactions are done through real estate agents. So you're looking at a 6% commission, another 2 to 3% of the sales price goes towards closing costs. Just so for easy math, let's say anywhere from 8 to 10%, right? So if you're trying to sell a $400,000 house and 6% is the agent and 10% is closing, I'm sorry, the other 2 or 3% is closing costs, and you add those two together is how you get your 10%. That's like $40,000 in commissions and closing costs. So that family's upside down. I would rather have that higher payment, assuming that they could afford the payment and service that debt, because in the event there's a life crisis, family number 2 has purchased a home at an affordable, marketable price, and they have less money that they would have to bring to the table in the event that they would have to basically sell that home. Hopefully in this scenario, whether the payment was $1,393 or $1,746, both households did some rent analysis to figure out if you had to leave that house and rent it out, can you service that debt, which is ultimately important. So these are things that you have to be aware of. Very few agents drill things down like this. I've got quite a few people on the sideline that I told not to move forward in 2021, and they are very, very happy. Just as a side note too, for those of you who don't know, I am a licensed broker in the state of Washington, and I am a licensed mortgage loan officer. So what I'm saying is that it all depends upon your situation, but more importantly, are you comfortable servicing that debt? I think in the long run, I would choose the right price, assuming that I can afford the higher mortgage payment. Interest rates will come down. Historically speaking, every time we have a recession, inflation comes down, but guess what else comes down with inflation? Home prices. And that has been the historical fact since 1960. I didn't bring that chart up, but if you go back and look at that type of information, anytime there's a peak in inflation and then we hit a recession, consumer prices come down, inflation comes down, but so do home prices. And with that, interest rates will come down eventually because the lending environment has to do something to entice consumers to want to make long-term purchases again. So I hope you found this video in a good place. I'm going to end it with my motto: keep your credit score up and your debt down. Once again, please subscribe to my channel if you haven't. This was the Kevin Strong Show, and I'll see you guys in the next video.